Section 3.1 Understanding Standard Deviation, Section 3:1 Standard Deviation in Finance and Investments, 3.1 Risk and Volatility. In financial markets, standard deviation is commonly used as a measure of risk. It quantifies the historical or expected volatility of an investment or portfolio, providing insights into the potential range of returns or price fluctuations. Here's how standard deviation relates to risk in financial markets, volatility, and price fluctuations. Standard deviation captures the variability or volatility of investment returns or prices over a specific period. Higher standard deviation implies greater price fluctuations or return volatility, indicating a higher level of risk. Investments with higher standard deviations are considered more volatile and carry a greater potential for large price swings. On the other hand, investments with lower standard deviations are generally perceived as less risky due to their relative stability and smaller price fluctuations. Risk and uncertainty. Standard deviation is an important tool for assessing risk and uncertainty in financial markets. It helps investors understand the potential range of outcomes and the likelihood of extreme price movements. A higher standard deviation signifies a wider distribution of potential returns, indicating higher uncertainty and associated risk. Investors who are risk-averse may prefer investments with lower standard deviations and lower levels of uncertainty. Diversification and risk reduction. Standard deviation plays a role in portfolio management and diversification. By combining assets with different standard deviations in a portfolio, investors can reduce the overall risk or volatility of the portfolio. This is because assets with low or negative correlations can offset each other's price movements, resulting in a lower overall portfolio standard deviation. Diversification helps spread the risk and potentially improve risk-adjusted returns. Risk measurement and comparison. Standard deviation allows for the measurement and comparison of risk across different investments, asset classes, or portfolios. Investors can compare the standard deviations of various assets to assess their risk profiles and make informed decisions based on their risk tolerance. By evaluating the standard deviations of different investments, investors can choose investments that align with their risk preferences and investment objectives. Risk-return trade-off. Standard deviation is often used in conjunction with other risk measures to evaluate the risk-return trade-off of investments. Investors generally expect a higher return for assuming higher levels of risk. Investments with higher standard deviations often have the potential for higher returns, but they also carry higher risk. Conversely, investments with lower standard deviations tend to have lower expected returns but are perceived as less risky. In summary, in financial markets, standard deviation serves as a measure of risk, capturing the volatility and potential price fluctuations of investments. It helps investors assess the potential risk and uncertainty associated with an investment or portfolio. By understanding the relationship between standard deviation and risk, investors can make informed decisions and manage their portfolios based on their risk tolerance and investment objectives. Standard deviation is widely used as a measure of volatility in investment returns. Volatility refers to the degree of fluctuation or variability in the price or value of an investment over time. Here's how standard deviation is interpreted as a measure of volatility in investment returns. Magnitude of standard deviation. Standard deviation quantifies the average amount of deviation or dispersion of investment returns from their mean or average return. A higher standard deviation indicates greater volatility, suggesting that the investment's returns have experienced larger and more frequent fluctuations. On the other hand, a lower standard deviation implies lower volatility, indicating a more stable and less variable return pattern. Historical volatility. Standard deviation is often used to measure historical volatility, reflecting the actual price or return movements observed in the past. A higher standard deviation in historical returns indicates that the investment has experienced larger price swings, making it more volatile. Investors often analyze historical volatility to understand the level of risk associated with an investment and to gauge potential future volatility. Implied volatility. In options trading and pricing, standard deviation is used to estimate implied volatility. Implied volatility represents the market's expectation of future volatility based on the prices of options contracts. Higher implied volatility suggests that the market anticipates larger price movements in the underlying asset, indicating higher expected volatility. Conversely, lower implied volatility implies lower expected future volatility. Risk assessment. Standard deviation helps investors assess the risk and uncertainty associated with an investment. Volatility is often seen as a measure of risk, as higher volatility introduces a greater potential for both positive and negative returns. Investors with a lower risk tolerance may seek investments with lower standard deviations, indicating lower volatility and potentially more stable returns. However, some investors, such as those pursuing aggressive strategies or seeking higher returns, may be willing to accept higher volatility and the associated risks. Portfolio management. Standard deviation plays a crucial role in portfolio management and asset allocation. By considering the standard deviations of different investments, investors can construct portfolios that align with their risk preferences. Combining assets with different volatilities can help diversify the portfolio and potentially reduce overall portfolio volatility. Investors often aim for an optimal balance between risk and return by diversifying investments with varying standard deviations. In summary, standard deviation is interpreted as a measure of volatility in investment returns. It quantifies the average amount of dispersion or fluctuation in returns, allowing investors to assess historical and implied volatility. Understanding standard deviation as a measure of volatility helps investors evaluate risk, manage portfolios, and make informed investment decisions based on their risk tolerance and investment objectives.